Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Today we will be talking about eBay. eBay provides an internet service through which it brings buyers and sellers together in a fixed price and auction-driven formats so that it can better facilitate the buying and selling of various items. Today we will review the company's 10K annual report to get a better idea of its business model. Then we'll look at the company's fundamentals by focusing on its key ratios. We'll perform a discounted free cash flow DCF analysis to find the intrinsic value of the company, and finally do an expected rate of return calculation to see if you were to invest in eBay at the current stock price, what kind of return can we expect on this investment? So let's dive in and review eBay.
Hey guys, let's start off by looking at the Form 10K, which is the annual report that eBay filed with the SEC. This is for the fiscal year that ended December 31st, 2020. And on page 4 of the report, the company provides us a business overview. eBay states that it is a global commerce leader through its marketplace platforms, which connects millions of buyers and sellers in more than 190 markets around the world. The platforms includes its online marketplace located at www.ebay.com and its localized counterparts, including off-platform businesses in South Korea, Japan, and Turkey, as well as eBay's suite of mobile apps. On the next page, eBay talks about its strategy. eBay states that its business model and pricing are designed so that its business is successful when its sellers are successful. eBay earns revenue primarily through fees collected on successfully closed sales and its growth drivers of managed payments and first-party advertising. eBay's strategy is to leverage technology to enhance marketplace experience for its customers, to drive growth in gross merchandise volume while increasing the rate of revenue growth through its managed payments and advertising initiatives and delivering healthy operating margins. So essentially, eBay makes its money through its marketplace segment, where it charges two kinds of fees: the insertion fee, which is charged when the sellers list their products, and the final value fee, which is the commission eBay charges and can range from 2% to 12% of the total sale price. Next, on page 83 of the report, the company provides us detail about its business segments. It states that it has one operating and reportable segment, which is the marketplace segment, which includes its online marketplace located at www.ebay.com, its localized counterparts, and the eBay suite of mobile apps. eBay points out that it classified the results of its previous StubHub and classified segments as discontinued operations. After that, the company provides us a revenue breakdown over the past 3 years. When we look at the past 3 years of net revenues, we can see that there was a slight dip in the net revenues in the year 2019 when compared to that of 2018. However, that net revenue recovered in the year 2020, as the net revenue in the year 2020 was about $10 billion as compared to the $8.6 billion observed in the year 2018. On the next page, eBay provides us a revenue breakdown by geography. In the year 2020, we can see that the United States brought in about 40% of the company's total net revenue. The United Kingdom brought in about 17%, South Korea brought in about 14%, and Germany brought in about 11% of the company's total net revenues. Finally, looking at the long-lived assets by geography, we can see that the United States has about $1.6 billion out of the total $1.9 billion of long-lived assets, which means that about 85% of the company's total long-lived tangible assets are located in the United States. Now that we have a brief understanding of eBay's business model, its strategy, its one reportable segment, and the revenue breakdown, let's review the company's fundamentals by focusing on its key ratios. Hey guys, now let's look at eBay's key ratios. I'm on Morningstar looking at eBay. Under key ratios, we have the financials. The first item on the list is the revenue. The revenue is the top line of the income statement. This is the amount of money that the company brings in via sales. Back in 2011, eBay's revenue was about $11.7 billion, and for the year 2020, it was about $10.2 billion. When we look at the past 10-year trend, we can see that eBay's revenue was trending upwards from 2011 through 2014. In fact, it got to a high of about $18 billion in 2014. Then it saw a decline in the year 2015 when its revenue dropped to about $8.6 billion. And ever since that year, the company's revenue has been trending upwards. Next, looking at the operating income. The operating income is what we get when we subtract the cost of goods and operating expenses from the company's revenue. Back in 2011, the company's operating income was about $2.4 billion, and for the year 2020, it was about $2.7 billion. eBay's operating income has a similar trend as the trend of the company's revenue. After that, looking at the net income is the bottom line of the income statement. This is the amount of money that's left with the company once it has paid for the cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes. Back in 2011, the company's net income was about $3.2 billion, and for the year 2020, it was about $5.7 billion. eBay's net income does not have a similar trend as that seen in the company's revenue and operating income. That tells us that the company has below-the-line expenses which either inflate or deflate the company's net income. In other words, eBay makes one-time sales or purchases which actually increases or decreases the company's net income numbers. Ideally, we want to see the company's net income number to be positive, staying steady, or increasing. However, in the case of eBay, we can clearly see the volatility in the company's net income numbers. Next, looking at the dividends per share. Back in 2019, eBay paid out about 56 cents per share as dividend, and for the year 2020, it paid out about 64 cents per share as dividend. After that, looking at the shares outstanding, back in 2011, eBay had 1,313 million shares outstanding, and for the trailing 12 months, the company had 702 million shares outstanding. Ideally, we want to see the company's shares outstanding number to be decreasing, as that means that the company is buying back its shares, which helps increase the existing shareholders' ownership within the company. Next, looking at the book value per share. The book value is what we get when we subtract the company's total liabilities from its total assets. Back in 2011, the company's book value was about $12.57 per share, and for the trailing 12 months, it's about $5.53 per share. eBay's book value per share has always been positive, which tells us that the company always had more assets than liabilities on its balance sheet. Finally, looking at the free cash flow. The free cash flow is what we get when we subtract the capital spending from the company's operating cash flow. Back in 2011, eBay's free cash flow was about $2.3 billion, and for the year 2020, it was about $1.9 billion. Ideally, we want to see the company's free cash flow number to always be positive, staying steady or increasing. In the case of eBay, the company's free cash flow number has stayed fairly consistent since 2016. I will be using the past 10 years of free cash flows for my expected rate of return calculation, and I will be using the 2020 figure of $1.925 billion for my discounted free cash flow DCF analysis. Now let's look at the profitability of the company, focusing on the net margin. The net margin is the ratio of the company's bottom line to its top line, so it compares the company's net income to its revenue. Back in 2011, the company's net margin was about 27.72%, and for the year 2020, it was about 55.17%. What this means is, in the year 2020, every $100 that the company made in sales, by the time it paid for its cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes, it had $55.17 left as pure profit. Next, looking at the return on equity. The return on equity is the ratio of the company's net income to its shareholders' equity. Warren Buffett prefers to only invest in securities that have a return on equity of 8% or greater every year for the past 10 years. Back in 2011, eBay's return on equity was about 19.44%, and for the year 2020, it was at 176.24%. The reason of these high inflated return on equity numbers is because the company has been buying back its shares, which decreases the equity portion on the balance sheet, so when we compare net income to a tiny equity portion, we're bound to get inflated return on equity numbers. Next is the return on invested capital. This number gives an idea of how good the management is at allocating the company's capital and getting a return on that investment. Back in 2011, the company's return on invested capital was about 17%, and for the year 2020, it was about 51.62%. eBay's weighted average cost of capital, also known as the company's hurdle rate, is about 7.3%, and since the company's return on invested capital is greater than the company's weighted average cost of capital, we can safely say that the management is creating value for its shareholders. Finally, looking at the interest coverage. The interest coverage is the ratio of the company's income to its interest obligations. So it gives us an idea of how many times can the company pay off its interest using its income in that calendar year. Back in 2011, the company's interest coverage was about 157 times, and for the year 2020, it was about 11 times. Benjamin Graham, the father of value investing, preferred to only invest in securities that had interest coverage of 5 times or higher. Now let's look at the financial health and liquidity ratios. The first item on the list is the current ratio. The current ratio compares the company's current assets to its current liabilities. Ideally, we want to see the company's current ratio to be greater than 1. It's even better if it's greater than 1.5. A current ratio greater than 1 tells us that the company has enough current assets to fulfill its current liabilities over the next 12 months. Back in 2011, the company's current ratio was at 1.88, and for the latest quarter, it's at 1.3. Over the past 10 years, the company's current ratio has always been greater than 1.0. Next is the quick ratio. The quick ratio is similar to the current ratio except we disregard the inventory component. In other words, quick ratio is equal to current assets minus inventory divided by current liabilities. Ideally, we want to see the company's quick ratio to be greater than 1.0, as that means that the company does not have to rely on selling its inventory in order to fulfill its current liabilities. Back in 2011, the company's quick ratio was at 1.8, and for the latest quarter, it's at 0.92. eBay's quick ratio should be fairly similar to its current ratio because eBay barely has any inventory. Unlike Walmart and Amazon, eBay does not purchase any inventory and sell that. eBay simply acts as a facilitator between the buyers and sellers. Next, looking at the financial leverage. The financial leverage is the ratio of the company's total assets to its shareholders' equity. A high financial leverage ratio tells us that more of the company's assets are financed via liabilities. Ideally, we want to see the company's financial leverage to be staying steady or decreasing. However, in the case of eBay, the company's financial leverage has been trending upwards. The company's financial leverage rose all the way up to 6.33 back in 2019. It has been decreasing since then. However, the company is still a lot more leveraged now than it was 10 years ago. Finally, looking at the debt to equity ratio, this ratio compares the company's total debt to its shareholders' equity. Ideally, we want the company's debt to equity ratio to be less than 1. It's even better if it's less than 0.5. Back in 2011, the company's debt to equity ratio was at 0.09, and for the latest quarter, it's at 1.64. Similar to the company's financial leverage, the company's debt to equity ratio was a lot better 10 years ago than it is today. eBay has higher financial leverage and debt to equity ratios than those of Amazon and Alibaba. Now let's look at the efficiency ratios. The first item on the list is the day sales outstanding. This number gives an idea of how many days go by from the day eBay recognizes its sales to the day it actually receives cash for that service rendered. Back in 2011, eBay's day sales outstanding was about 18 days, and for the year 2020, it's about 20 days. Ideally, we want the company's day sales outstanding number to be staying steady or decreasing. An increasing day sales outstanding number tells us that the company is being aggressive with its accounting, as it's recognizing its sales sooner so that it can inflate its income numbers on the income statement. In the case of eBay, the company's day sales outstanding number has stayed fairly consistent over the past few years. Next, looking at the payables period, this number gives an idea of how many days does eBay take to pay its suppliers. Back in 2011, eBay took about 25 days to pay its suppliers, and in the year 2020, it took the company about 44 days to pay its suppliers. Ideally, we want the company's payables period to be staying steady or decreasing. An increasing payables period tells us that the company is holding on to its cash in order to artificially inflate its cash flow numbers. Over the past few years, the company's payables period has stayed fairly consistent. Now let's compare eBay's current valuation to that of the S&P 500. The S&P 500 is the aggregate of the top 500 companies in the United States. The first item on the list is the price to earnings ratio. eBay has a PE of 17.9, whereas S&P 500 is at 26.5. eBay has a price to book of 12.3, whereas S&P 500 is at 4.4. eBay has a price to sales of 4.3, whereas S&P 500 is at 3.2. eBay has a price to cash flow of 16.6, whereas S&P 500 is at 17.6. And finally, the dividend yield. eBay has a dividend yield of 1%, whereas S&P 500 is at 1.5%. We can see that other than the price to earnings and price to cash flow, eBay is overvalued when compared to the S&P 500. Hey guys, now let's look at the discounted free cash flow DCF analysis for eBay. Over here, I pasted eBay's 2020 free cash flow number that I got from Morningstar, which was at $1,925 million. I'm using an annual growth rate of free cash flow to be 7%. What this means is I expect eBay's free cash flow to grow at 7% every year for the next 10 years. I'm using a discount rate of 10%. What this means is I want this investment to give me a 10% return. I'm using a long-term growth rate of 5%. What this means is after the 10-year mark into perpetuity, I expect eBay's free cash flow to grow at 5%. The company has 702 million shares outstanding and has long-term debt of $7,735 million. I got this number from eBay's balance sheet. After taking all of these inputs into account, we get the intrinsic value to be about $55 per share. When we compare this intrinsic value to the company's current stock price of about $68 per share, we can see that the company's current stock is trading about 23% above the company's intrinsic value. The way we calculate this intrinsic value is we look at what the free cash flows would be every year for the next 10 years. We sum up all those free cash flows, which come out to about $16.6 billion. Then we look at what the free cash flows would be after the 10-year mark into perpetuity. We sum all those up to get the intrinsic value to be about $46.4 billion. From this number, we subtract the long-term debt and divide by the shares outstanding to get the intrinsic value per share to be about $55. Now, if we disregard the perpetuity component, in other words, if we think that eBay is only going to grow for the next 10 years and then it'll cease to exist, then we get the intrinsic value without the perpetuity to be about $13 per share. And finally, if we disregard the debt, in other words, if we think that eBay is going to grow into perpetuity, so there is no point for the company to even worry about paying its debt, then we get the intrinsic value without the debt to be about $66 per share. Finally, we know that the company's weighted average cost of capital, also known as the company's hurdle rate, is about 7.3%. And if we add a 1.5% margin of safety on top of that and make our discount rate 8.8%, then we get our intrinsic value to be about $77 per share. And in this situation, the company's current stock is trading about 12% below the company's intrinsic value. Hey guys, now let's look at the expected rate of return calculation for eBay. Over here, I pasted the past 10 years of free cash flows that I got from Morningstar. All the numbers here are in millions of US dollars. This is the yearly free cash flow trend that we get over the past 10 years. We can see that the free cash flows peaked back in 2014, and over the past few years, the company's free cash flow have stayed fairly consistent. Next, looking at the future data and predictions, I'm assuming that there's a 35% likelihood that eBay's free cash flow will grow at 7%, there's a 50% likelihood that its free cash flow will grow at 4%, and a 15% likelihood that its free cash flow will grow at 3%. These are the potential free cash flow rates that we get into the future. After taking into account the numbers of shares outstanding, which is at 702 million shares, at the current stock price of about $68 per share, we can expect to get an annual return of about 3.8% on this investment. What this means is if you were to purchase a share of eBay at the current stock price of about $68 per share and hold the security through 2060, then we can expect to get an annual return of about 3.8% on this investment. Hey guys, now let's wrap it all up. We briefly went over eBay's 10K annual report and saw that the company has one reportable segment, which is its marketplace segment. When we looked at the key ratios, we saw that the company's revenue and operating income has stayed fairly consistent. The net income, on the other hand, has been fluctuating over the past 10 years, which tells us that the company's below-the-line expenses and one-time sales or purchases are either inflating or deflating the company's net income numbers. eBay has been paying dividends since 2019, and the company has also been buying back its shares every year since 2013. eBay's return on equity has almost always been greater than 8% every year over the past 10 years. The company's return on invested capital is greater than the company's weighted average cost of capital, which tells us that the company's management is creating value for its shareholders. Additionally, eBay's interest coverage is greater than 5 times. When we looked at the company's current and quick ratios, we saw that the company has more than enough current assets to fulfill its current liabilities. In other words, the company has enough oxygen in its system to survive for the next 12 months. Next, we saw that eBay's financial leverage and debt-to-equity ratios are a lot higher now than they were 10 years ago. In fact, eBay's financial leverage and debt-to-equity ratios are higher than Amazon and Alibaba's. After that, we saw that on majority of the company's current valuation metrics, eBay was overvalued when compared to the S&P 500. Next, when we performed the discounted free cash flow DCF analysis using a 10% discount rate, the intrinsic value came to about $55 per share. When we dropped the discount rate to 8.8%, the intrinsic value came to about $77 per share, which would mean that the current stock price is trading about 12% below the company's intrinsic value. When we performed the expected rate of return calculation, we found out that if we were to purchase a share of eBay at the current stock price of about $68 per share, then we can expect to get an annual return of about 3.8% on this investment. Overall, even though eBay is highly leveraged, it seems to be a good company with strong fundamentals. Additionally, eBay's investment in marketing and technology should allow the company to increase purchase frequency and capture new buyers. And lastly, eBay has announced its expansion plans in Greater China, which indicates that the company has a long roadway of growth ahead. Hey guys, that is all I had for you this week. Hopefully you found this video on eBay interesting. If you like this content, please do like, share, comment, and subscribe. And if you have any suggestions on which stock I should review next, please leave it in the comment section below. I'll greatly appreciate it. Thank you.